You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Jim, good to be with you on this Friday. It's been a very interesting week or so in the financial market. And what we're looking at here right now is the Dow Jones being down 230 points, other indexes down about the same drop, and another slide in the price of crude oil. What we're looking at is this could be defining the top of the bull market that started in March of 2009. We should recall that that was a full-fledged panic. The establishment was calling it a financial collapse, and which was interesting. We'll just do a little sidebar here, that at the top of the market near the end of 2007, the establishment said that nothing could go wrong because they had a, quote, dream team of economists at the Federal Reserve. Then we went into the worst financial collapse since 1929, 1930. Policymakers became desperate. And of course these things run their natural course, and eventually everybody who is offside is forced out or covered, and then the markets relieve and then head up. And so shortly after it was heading up, they were all going around saying that if they hadn't acted, I mean these are the central bankers, if they hadn't acted, the crash would have continued. So they switched in a year and a half's time from saying a crash was impossible, and then they switched and said that if they hadn't acted, the crash would have continued. I mean, this requires severe criticism. But at any rate, moving forward to where we are now, I think it's been the first business cycle out of the crash, the first bull market out of the crash, and it has had legs. It's gone on and on. I think largely due to the unusually strong buying of bonds by the Federal Reserve, and then more recently by the European Central Bank. Also, we saw one the other day where the Bank of Japan has not just been buying bonds in Japan, they've also been buying the equity markets, which is just plain foolishness. So there's been a hand at work, but there is also the hand of the market that is countering all these magnificent efforts that the policymakers are doing. And this shows up in the technical work on the stock market, where we have been looking for this as a big rounded top, and we've been using the NYSE composite to represent the whole market. And it was making highs from June on, a number of them. And you also had with this sentiment figures that were very high, very bullish, seen only at previous market tops. And you also had some momentum numbers that were outstanding, seen only at cyclical tops. So then they got this other leg out of the market more recently, where the Dow and the S&P and the NASDAQ went up and made new highs. And this included the broad market, the New York Stock Exchange Composite, which the ETF is NYA. And this looked like to us an upthrust market, a breakout. And considering the changes going on in the credit markets, we figured it could be a failed breakout. And now this is being confirmed by weakness since. So the other one that we've been using here for account has been that on the S&P back in October, that sell-off generated a springboard buy on a technical model we have, and it would run. You also have favorables from October, seasonals from October through to May. That was a positive. But one of the items that looked good was when the crash in crude oil ended in January. Ross, my colleague, noted that you can get rallies for the stock market that lasted about 6 weeks, and that counted out to early March, early this month. So that was a plus that became a negative. And the other one that we were looking at was that the crude oil market itself would stabilize for a number of months. A lot of the street were expecting a V bottom for crude oil and oil stocks, and no, that doesn't follow a crash. the stability can last for 2 or 3 months before you then get a new bull market. But what we've been concerned about recently is that this stability in crude before you can have a rally could run out into where the signs of a business recession, and weakness in industrial commodities is saying that maybe there could be a global recession developing. And then more recently, through Christmas, there was a lot of the business and economic numbers were very positive, and then all of a sudden they've turned disappointing or negative or weak. Then there's a chart we look at occasionally with it's a line that represents all the macroeconomic forecasts, and it has been heading down since the fourth quarter while the stock market is heading up, so there's quite a divergence there. But the main thing is the stock market is telling us the story, and it is a failed breakout. Now, there's one other backup on timing that we had, which was the old Dow theory, which dates back to about 1900. And it notes that for a bull market to continue each of the rallies, you want to have the Dow and the transport indexes making highs together. So the last high together for these two was right at the end of December, and then on February 14th, Valentine's Day, we dragged this one out and took a look and said, hey, this is interesting, because on that Dow theory we're getting non-confirmation from the transport, and if it runs for about 6 weeks, then you can have a modest correction. On the other hand, if that non-confirmation with the Dow or the transports not making new highs, as it runs longer and longer, when the decline comes in, it's larger. So it ran 10 weeks of non-confirmation. So we're looking for, on that basis, a more serious decline than otherwise, which we're getting. So we're looking at again, the NYA. It is, we wanted to see it take out the 40-week moving average, and that would then more or less crystallize things. So that side on the stock market now looks very, very heavy. That's a good way to phrase it. There was another trick we had going in here, which was the yield credit spreads and the difference between high-grade bonds and low-grade bonds, which turned on a seasonal model back in June, and you had weak junk bond prices and widening credit spreads, and that was tied to crude oil, and so the spread got to its worst in January, sort of as crude was finishing its first decline. And now it is, let's say that the spread market has had a correction until just earlier in the week, and then it started to widen again. So we looked back in 2007, and that spread market told a similar story, that it started to widen, then it took the first correction, and of interest is that that correction ended in October and started to resume the widening on the high day of the stock market. I think it was October the 17th or something like that. So this time around, that same pattern where you had the resumption of widening was pretty close to the top here. So I thought that was fascinating as we were watching it. So we've got further widening of spreads in here now. So as a guide, this widening of credit spreads, it's something that the Federal Reserve can't do anything about. Yes, they can push short rates down, and we've seen recently that they can really push long rates down by just endlessly buying bonds. But in the past, they've never been able to change affect the yield curve or credit spreads. And so far we got the change in the curve in the spreads, and we're looking for the change in the curve at some point. And again, Mother Nature will have been seen to have overwhelmed the policymakers. And while we may not like a bear market, I think it's important for the overall history of the financial markets for the public to see that the central bankers really don't have the power that they claim to have.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Bob Hoye. Bob, can you tell us about this question we've received from the Netherlands?
Yeah, William from the Netherlands said that I, Bob Hoye, from time to time say that central bankers need to have a PhD in currency depreciation and always want to debase the currency. But I never fully understand why governments and central bankers want to have a weaker currency. Can Mr. Hoye provide more details on why weaker currencies are so desirable for many countries? Is this based upon the assumption that a weak currency would help increase exports, or are there other reasons? Well, I think, William, that if a central banker was doing nothing, his job wouldn't be justified. So in order to do something, they have to fiddle around with the credit market. That then, in turn, depreciates the currency. So, but they have this idea that as business expands, so does the credit outstanding. So credit expands, business expands. But they've got a cause and effect in there that isn't true. They think then if they expand credit, that'll push business. And, oh, no, that one doesn't work. But I think in the main, the central banking concept, while perhaps somewhat legitimate at the start, has been corrupted by the ambition of big government, so that eventually the central bank is just, in the case of the Federal Reserve or the Bank of Canada, exists only to fund an experiment in unlimited government. So they are there to provide unlimited funding. And but the irony is that that recently it's not pushing the economy at all. The economy is beginning to slow. And then the other thing, I think why they're very worried about deflation is that they haven't figured out how to tax it. So they know how to tax rising prices, but they don't know how to tax falling prices. So we'll see how that works. But then talking about inflation or deflation, that gets us into the precious metal sector. And we've always looked at gold in real terms, like its purchasing power. And we use a commodity index to define that because if you had an honest calculation of the consumer price index, we could use that, but it's dubious. So at any rate, throughout the last 300 years of financial history, gold's real price goes down on a boom. Yeah, gold is money. And as on a boom, things go up in price, so you buy fewer of them, so the purchasing power goes down. Then in every contraction, price of things goes down relative to money, and gold being money, you can buy more things with that. So it gets more sophisticated than that because in a contraction, and that is defined by credit contracting and lack of liquidity and all sorts of distress, that underneath it all, the global banking system needs the liquidity of gold, and the real price goes up, so it becomes more profitable to mine it. And we can really see this now in the last year, where crude oil has fallen greatly relative to gold. So crude oil represents a large part of the cost of mining, and it's dropped, and then there's a lid on it now. So by this basis, gold mining should be becoming more profitable. And actually, gold is also outperforming base metals and all other costs. So this is how Mother Nature starts to reliquefy a global economy after a crazy bubble in debt instruments. So we continue to see the real price of gold go up, but at the moment the gold stocks are low. They had a nice rally coming out of December. It got a little overdone and are now down again. But our advice on the gold stocks has been to be selective, to accumulate a little on weakness, because it's going to take quite a while for the whole sector to bottom. And this is where the opposite side is coming in, where you've had bad markets in the gold sector while there's been a party in bonds and stocks. And this opposite will come in here now, where the gold sector is bottoming as the orthodox side of investments has been topping. So there's a crossover going here that will really drive the next leg up in gold's real price, and that will eventually pull up the price of gold stocks. But in the meantime, and this is some heavy-duty liquidation going on in the general stock market now, that's not going to help gold stocks. So I think the next few weeks in the stock market generally could be heavy, and that would be a bit of a lid on gold stocks. Now, we had one more thing going on in gold, and that was there's a seasonal pattern in here, is that if gold itself is weak into the middle of March, it can enjoy a rally out of there. And we've called it the Ides of March pattern, based on the old Roman designation of the middle of the month being called the Ides. So weakness in gold now, and weakness in gold shares going into the Ides of March, which is next week, is on one pattern, and it could be followed by certainly a rally for gold, and maybe a little recovery for the gold stocks. But as I say, the problem could be the downward pressures on the general stock market.
Bob, thanks a lot for chatting with us.
Always good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward questions like they have from the Netherlands to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.